you notice it's a pyramid with a foundation, which is a well-written financial plan. But then when you're applying your money, I would say there are 3 stages. At the bottom is managing your risk. Putting money aside to help you manage risk, or better still, reduce the exposure to family struggles or some kind of financial embarrassment, those challenges that that may happen. This is why you put insurance, for instance. This is why you put an emergency fund. Okay? Things that you need to protect yourself. The next webinar, we shall be talking about insurance. So this one, we shall talk about investment. The next level, which is our interest, is accumulation of wealth, right? Where you are making your investment to accumulate wealth. So that I do not forget 2 areas that are important for you to keep remembering. 1, it is good that you have life insurance associated with education services. You can combine the 2, and they help you in saving in tax. They also help you to meet the expectation of your children's education. Let me emphasize retirement plan. Many of us miss this point. It's an investment for the future. And a good number of us entrepreneurs, sometimes even employees, we do not set aside sufficient amount for retirement. Okay? And particularly men in the house, David Makatiali and others, men in the house. I would like to remind you a lot. Yesterday I saw a clip that was circulating in social media. What's up? About a lady, I think Nigerian, advising men, you better take care of yourselves. And she will put it very plainly and simple. When you are strong and bringing up your children, everybody looking up to you, everything looks okay. When you grow up, okay, when you grow old, things change. And you may realize the things that you used to do, you can't do. And some of the people you are taking care of do not have the idea that you need to be taken care of. They have the belief that you're still daddy, you take care of yourself. In the process, you actually find yourself at the mercy. Please invest for your old age, my good friends, retirement. Then, of course, we can get to investment where we speculate, change in price. Buy when the price is low, sell when the price is high, and it can be many kind of high-risk investment. We want to group this a little bit better to understand them in terms of timing, in terms of perhaps volume. So, in investment strategy to grow your income, remember rule number 1, given by Warren Buffett. Never lose money. And in rule number 2, never forget rule number 1. It's good to think about the various investments available, and then you can link them to your goals. Non-marketable financial assets, bonds, mutual funds, real estate, equity, life insurance policies, financial derivatives, and bank deposits. Each one of them different characteristics and perhaps being useful at different times. What do we therefore need to do? We need to develop an investment strategy. Develop an investment strategy. A decision regarding how to manage your investment portfolio to meet your goals and your objectives. Okay? And when you're saying investment strategy, it is not investment strategy for the business assets. No, it is now personal and family assets, personal wealth, building your wealth. So you need to do that. Remember investment and strategy. Now, most investors jump into investment as soon as they start thinking about investment. Oh, I need to buy shares. Pop. Okay. Some of us make choice based on our friends' recommendations. Everybody is buying shares of such and such a company. We all go there. Okay. And you know that euphoria many times causes a lot of loss. I'll be capturing one of them later on. So that's not strategy. In order to make choice, okay, you have to start from the second part of the sentence, which is investment strategy. Strategy. And strategy means ways and approaches in which you get long-term objectives. How do I start? The first step, as usual, even in business you see the same, is to plan. Plan involves setting your goals, your objectives, the methods or ways of achieving that, strategies, tactics, policies that will help you achieve those objectives. Right? Many times if you approach investment managers, they will tell you, okay, that it is important to have a clear investment roadmap. They often may advise you to have your personal investment policy statement, a written document that sets out your return, objective, risk tolerance over time, along with applicable constraints such as liquidity needs, tax consideration, regulatory, right, and unique circumstances. My good friends, if you have approached an investment banker or advisor, on average you tell them, I want to invest, and they ask you this kind of question: for how long do you want to invest that money? Okay? What would be your liquidity needs? Okay? What are unique circumstances in your life and your business? So that you don't end up buying shares when the price is high and then you sell them when the price is low because you need the money. Okay? So setting your return objectives is important. Don't go with the euphoria of the argument that, well, my friend bought shares at 11 shillings, ended up selling them at 33 shillings. That was 300% return 3 times. It can happen, but don't expect to happen all the time. And don't set your return at 300 because your friend told you 300. Be realistic. Be realistic. Okay? Very consistent with the risk. If you buy perhaps shares of a stable company, the chances of the risk are low if it's a stable company. So a low return is all right. Okay? If it is a risky company, be prepared. It is good to express your objective in terms of total return, something like 10%. Okay? 10% of my costs, or maybe 10% of the minimum return in the market, or another 10% above minimum return, something like that. Okay? It could be just general, or it could be adjusted for inflation. Many times you hear investors telling you, okay, you're going to get 10%, but inflation is 7%, so you have to net off. Okay? One may want to consider post-tax, okay, or pre-tax. The reason you sometimes look at post-tax, after-tax, is that some returns have different tax. Some attract capital gains, some do not. Some attract withholding tax, some do not. And that's why you may want to look at, when I have paid tax, what it means. So that tells you which is the best investment for you at a given time. Okay? So that's why you see the things like 10% pre-tax return, 5% above the benchmark, something like that. Okay? So what is your expected return? Obviously, you want to relate this expected return to the cost of your money. If you're borrowing and you want to invest money you've borrowed, then the rate of return better be higher than the borrowing rate. Right? If the treasury bills are giving you 6%, then you should consider the minimum return to be the 6%. These are the considerations you put. So it is not just the one-off. Okay? I think recently I shared with some of you who attended one of the company that I happen to be in the board. Okay? And the principal shareholder have a very simple expectation. It tells the board, give me a minimum of 10%. So the profit must be 10% of capital employed. Okay? And you ask him and you say, well, the alternative would have given me less. So if you give me less than 10%, then you're wasting my money. If you give me more than 10%, then I can share with you the difference because you have done something good for me. Set your objective based on those facts. As you do that, it's good to consider the investment constraints. You see, the money that is available must be considered in terms of time horizon. Is it long term or is it short term? This is the number one thing, my good friends, you consider when you're putting your money. When you have longer term money, you can have the ability to take higher risk. Take for instance, if you have money with a horizon of over 2 years, you can put it in shares. Okay? If it's less than 2 years, unless you have a very good background in financial management, it might be a serious risk for you to put it in the shares. It is better to consider the money market. So it's good to consider tax, as I said, the issue of withholding tax, capital gain tax. It's good to remember liquidity. When do you need back the money, or at what point might you struggle with the cash? Okay, when is it that you want to invest? When is it that you want to build at home? Okay, very important. The Capital Markets Authority have certain regulations. Some of those regulations protect you as an investor. Sometimes people say the regulation sometimes reduces the operations of the market to some extent to make it free. Well, that's a debate for another day. Okay. Other regulations like pension fund. Pension fund has to be protected because you're putting money to people to manage for you, right, without your control. So those are regulated, right? So you say, I will not buy investment in a business that carries out certain activities. Okay, weapons, alcohol or tobacco, you can see from Islamic regulations. Okay, some churches do that. Okay, or it could be perhaps consideration of complex investments. For instance, things like derivatives. I would advise you, don't put your money in complicated investments without proper financial advice. I can tell you even mega companies have lost because of not having proper advice in managing complex assets like derivatives. Just to give you a snapshot, if you know the collapse of mega companies like Enron in the US, it is perhaps said as the largest fraud in the history of the world. Behind it was assets called derivatives. So it is, I'm not scaring you, I'm saying before you enter into them, sit down with an expert in the area, right, who can guide you very well. So what are the considerations therefore of investment strategy once again? We have said time horizon, remember long term and short term. What does that mean? You're connected to number 4. You need to do your financial projection. Have you done your financial projection to see what money you need 1 month, 3 months, half year, full year, 3 years, 10 years? That's how you do your projection. Then you see if you have a flow of income that you do not need now in the next 10 years. Say for instance, you pay yourself a salary and you can put aside 10% of that you do not need for the next 10 years. You can put this aside in an investment like pension or high risk asset because there's sufficient time. If you notice you have excess money, you want to buy your goods in Dubai in the month of August. You have the money now, okay, or the money that's accumulating now. You want to put that in a fixed deposit for 1 month, and with some interest. And by the way, it's good you're talking with your financial advisor, Dr. Nyambura and Moses, about this kind of opportunity.